Into Market with me, Ankita Saxena, and with me is Kanishka Sakar. And in the next, we are going to tell you how to place your bets and how the market is really shaping up. For now, we're joined by Jyotivardhan Jaipuria, who's the founder and MD of Valentis Advisors, who's now joining us to weigh in on the markets. Hi, Mr. Jaipuria. Thank you so much for taking the time out and joining us. Mr. Jaipuria, let me ask you about the latest of what has happened, which has come as a bit of a shocker for the consumers and for the Alcobev companies as well. The increase in the excise duty by the Maharashtra government, which is the highest ever that we have seen since 2011. It's in fact, on the Indian-made foreign liquor, it is in the range of 50 to 60%, which is likely to lead to an MRP hike of almost 30 to 50%. For the brands. How do you see this entire pack, Alcobev pack playing out? Because people, analysts were getting incrementally bullish on the consumer discretionary, especially the Alcobev part. Now, with this news coming in, how do you see this shaping up?
Yeah, so we don't own these stocks, and that has been one of our concerns, that all of these are very, very dependent on government policies. And it's dependent on each state, and very often the states keep changing duties, and so that is what starts affecting the demand. If I look at a very macro picture, what we have to remember is a lot of states are struggling for revenue. And when they're struggling for revenue because of the subsidies they've given or the election promises they've given, stuff like alcohol becomes one very easy target from where they can raise revenues, because it's treated as, okay, this is for the rich people, it's not for the poor people. And that's been our concern, really, that it's very difficult to keep forecasting what each state does over here. So we've generally stayed away from this pack. I think this is going to be negative for demand for the sector.
That's right. Hi, Mr. Jaipuria. This is Kanishka also joining in. Before we discuss more of your sectoral bets, I also want to get your broader view on the market. Now, we are at an 8-month high when it comes to the Nifty. Last time we saw this level in October, right? So what are your expectations going forward in the next 6 to 12 months? What are the key factors we should be watching out for, especially in terms of global cues?
Yeah, so Tanchika, you're right that basically what we are seeing is like the market has recovered from its lows. The one good thing for us has been India's macros are looking very good. So if you think of the twin deficit, that's looking great. Inflation's coming down, especially helped by oil prices going down. RBI has been very proactive on the monetary policy front. So we have like a very easy liquidity. We've already they've pumped in like 6-7 lakh crores of liquidity. So the macro looking very good, and that is helping us. The valuations are not cheap. Earnings hopefully will recover. We saw some recovery in the March quarter, but still it was like, we are still running at less than single-digit returns. So hopefully, this year we'll have the forecast 10 to 11% growth, which helps us drive returns. Overall, like you said rightly, the concern is the global. So, basically, the Trump tariffs, the deadline for 90 days gets over the 9th of July. And so far, not many deals have got signed. Even India's deal is still work in progress. So we don't know whether he puts reciprocal tariffs back again, or what he does is he goes back and says, okay, I'll give another 90 days or another 60 days for negotiation to happen. And so, that is one thing which will weigh on the market. One positive for the market to the later part of this year and for the Indian market is that basically, MSCI does this review, and Korea is up for review again, and whether they will move to a developed status. If that happens, it will be very positive for all the other countries in the emerging market space. India's weightage will probably go up roughly 2% because of that. And that will help get flows to the Indian market. So that's a positive from the global, which we have to keep an eye on by the end of this month.
Right. Mr. Jaipuria, let's talk about the sectors then. Now, while there is a common consensus on the banking pack, the NBFCs and the financials, even the valuations look very, very reasonable. But what are the other sectors that you would be bullish on, and what are the bets that where you would be taking money off the table? What would be, the risks that you see, in the coming future?
Yes, you're right on the banks and financials. We are positive also, and I think more or less everybody's turned positive on it. Apart from that, one other sector we are bullish on, and just remember, we generally don't go by what is current momentum, but what is out of favor. So, we have a whole three-use philosophy which looks at sectors which are underowned and underperforming. So one sector which we've been playing now has been the chemical sector, which has been out of favor for quite some time now. The stocks have not done well for the last 2 years. And there are some interesting ideas which are coming up there, especially because what you're seeing at the dealer end globally is that a lot of dealers have actually destocked chemicals. Stocking level at the dealer is close to a 2-year low. And that's where we see some upside coming through in demand. Uh, Here we have to be careful because stocks are still not cheap. So look for stocks where there's a substantial earnings growth upside over the next 2 years. But in general, chemical is one stock we like. The other sector which we like is the cement sector. So cement again has not done much in terms of earnings growth, has been flattish for the last 12, 18 months. There have been a lot of consolidation in the sector. So that consolidation probably helps you over the next couple of years because it probably gets it easier to hike prices. Second is government demand should pick up. And so, for us, there are a lot of interesting ideas we are finding there. We're getting into the monsoon season, which is typically like a lean season for cement. So over the next, few weeks, pick up cement stocks when, we see a correction in them. So those would be two sectors we like. We also like the pharmaceuticals, but, there we have to be a little careful with Trump's tariffs because there's been a lot of talk from him that tariffs are coming, they're not coming. So a little careful there, but these are very, very secular growth stories, especially the CDMO pack in the pharma space.
That's right, Mr. Jaipuria. I was actually going to ask you about the pharma space only. Last time also we spoke, you had mentioned your preference for the sector. Now, what's your outlook there? Like within the pharma space, are there any particular pockets where you find more value than the others?
Yeah, so one of them is the CDMO space, where value is not there in the sense these stocks are not cheap. They are expensive. But for us, it is over the next 3, 5 years, there's a lot of visible growth which we'll see there. And so, just the sheer growth which we have, most companies there could have a growth compounded for the next maybe 3, 5 years or in the range of 25% plus. So that is what is really probably going to drive earnings in that space. None of these stocks are what I would say very cheap. So, when we look at it, we always think that the valuation have a lot of margin of safety, probably done, but we're quite confident that the earnings will play out. And so that is what we are playing. Now, there are two other spaces, obviously, in the pharma space. One is, the domestic pharma, and the other is the US generics, or in general, the global generics. So we've been actually more positive on the US generic side than on the domestic pharma side because that US generics had done quite poorly for 4, 5 years. And for us, it was we were sensing a turnaround. So we've been playing US generics for the past 18 months. That is why, there could be a lot of wobble if Trump changes some duties there. But for us, it is, the duties will create temporary dislocation. But Indian generics are like really cheap. So there won't be a longer term impact at some point. The consumer prices in the US will probably go up to reflect the duty changes. So we would be like bullish on US generics on any correction, and we like the CDMO space.
Like the CDMO space within the pharma pack, but Mr. Jaipuria, let's talk about the broader markets then. Firstly, after the correction that we've seen in the SMIDs, are you comfortable with the valuations? And also the second thing is that as far as the small caps are concerned, there could be an improvement in the earnings growth going ahead. And with that, now do you see comfort in buying into small caps, or would you still be wary of the broader market?
So, if when we started the calendar year, it was a very easy call that, the large caps will do better than the small caps. Because, that time the valuation disparity was huge. After the correction we saw in January, February, we became more neutral-ish. In fact, the tilt became slightly more towards the small and mid caps. Because like you said, the earnings are much stronger for the small and mid caps. Like if you see the last quarter, the earnings growth for the mid cap was like close to 17, 18%. The earnings growth for the small caps was, just about double digit. And the earnings growth for the large caps was more like 5, 6%. So the earnings growth will be sharp, and with, liquidity coming into the system, I think that earnings growth this year will surprise on the upside for the smaller mid cap, which will drive earnings. At the same time, one should be careful on being a very blanket call because there are a lot of pockets in the small mid cap which are not very cheap. So you have to look at valuations a little more closely because this is not like a runaway boom which we saw, post COVID where every small cap was flying. So I would say that, be little more positive on the small cap, but be careful of the valuations and look for stocks with earnings visibility.
Okay. Mr. Jaipuria, you were just talking about earnings in the mid cap and small cap space. So I want to get your overall view there. Last time we spoke, you said that the next leg of growth is going to be driven by earnings. And also, just before you were mentioning all the sectors that you prefer, they have an earnings upside. So last time you said that 12% recovery in FY26 is what you expect in terms of earnings. Do you still retain that view, or has it changed? And what's the outlook there? And which are the sectors that you think are going to drive this growth?
We still retain that view that we'll get, double-digit earnings of FY26. As you know, FY25 was a very weak year for earnings. So one is probably the base impact helps. And what you see over the next 6 months is like a very poor base of government corporate capex, which, so it will be easier to show growth for a lot of these companies which were dependent on government capex. The other thing which will help is liquidity is there in the system, rates are coming down, and so that will be very positive for earnings to come through. In terms of what will help, basically we'll see some of the engineering names and the capital good names continue to do well. Some of the consumer discretionary names especially will also show strong earnings growth. We'll see probably a rebound in some of these commodities like cement, which will again play an important role in terms of driving the earnings growth for next year, plus stuff like telecom.
Mr. Jaipuria, thank you so much for taking the time out and joining us with your insights into the market. But with that, it's time for us to slip into a short break. Don't go anywhere. We'll be right back. More updates on the market on the other side.